Welcome to this explainer. Today, we are putting on our expert investment analyst hats to cut straight through the noise surrounding one of the market's buzziest tech stocks right now, SoundHound AI. We're not just skimming the headlines here, folks. No, we are going to systematically unpack this company using the battle-tested frameworks of investing legends Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some rigorous discounted cash flow modeling to hunt down its true intrinsic value.
Okay, let's kick things off with a billion-dollar question that is completely tearing the consensus apart right now. It's retail speculators on one side, institutional Wall Street analysts on the other. See, proponents look at SoundHound and see this visionary enterprise with an incredibly deep technological moat, perfectly positioned to just dominate the voice AI revolution. But then, value investors look at the exact same data and they see a relentless, cash-burning machine that might actually be overvalued by a staggering 99%. So how do two completely different factions look at the exact same asset and arrive at such wildly different valuations? Let's figure it out.
Well, the absolute rocket fuel behind SoundHound's momentum is their explosive Q1 revenue growth. We are talking a massive 52% jump, hitting a record $44.2 million. And get this, if you exclude acquisitions, their core automotive and IoT vertical was actually up an unbelievable 88%. Now, looking through the lens of legendary investor Peter Lynch, this kind of crazy top-line expansion firmly drops SoundHound right into his fast growers category. And Lynch loved his fast growers. But, as any expert analyst will tell you, that enthusiasm comes with a huge catch. It's strictly conditional on the underlying financials actually supporting that expansion rather than just diluting shareholder value.
So to figure out if this growth is actually sustainable, we've got to apply the Warren Buffett lens and evaluate the company's economic moat. And honestly, at first glance, SoundHound has an impressive one. They hold over 280 patents in speech recognition and natural language understanding. They're processing literally millions of drive-thru interactions for big brands like Five Guys. They're expanding massively through their planned live person acquisition, and they just launched their self-learning OASYS platform. From a purely technological standpoint, this is exactly the kind of durable competitive advantage Buffett looks for. It's like a fortress. But, and this is a big but, for Buffett, a moat has to eventually translate into consistent, compounding owner earnings. And as we're about to see, this is where the bullish thesis slams right into a brick wall.
Right when we actually pull back the curtain on their foundational financial snapshot, we have to run Benjamin Graham's defensive investor checklist. Graham demands adequate size, undeniable financial strength, and absolutely crucially, earnings stability. SoundHound, they failed this test decisively. Sure, the revenue's soaring to that $44.2 million mark, but the underlying fundamentals expose a massive GAAP net loss of $25 million in a single quarter. Plus, they're posting an adjusted EBITDA loss of over $26 million, and their operating cash flow, negative $26.2 million. Essentially, for every single dollar they make in this explosive growth phase, they are bleeding cash. They're completely failing to provide the earning stability that a defensive investor requires.
There is this fascinating friction going on between management's sky-high optimism and the cold, hard reality of the balance sheet. When CEO Keyvan Mohajer talks to investors, he is laser-focused on top-line growth and incredible demand. Now, assessing management quality is another core Buffett principle, right? And to be fair, the executive team is absolutely delivering on scale and market penetration. But scaling currently costs them tens of millions of dollars in losses every 90 days. As analysts, we have to call it like we see it. This massive expense profile completely destroys any chance at the high return on equity, or ROE, that Warren Buffett unequivocally demands.
And that friction, it has created absolute chaos in the stock price. The share price has basically been orbiting around $6.75, with wild, massive spikes driven by AI hype, followed by these incredibly steep drop-offs the second reality sets in about their timeline to actual profitability. This extreme volatility makes establishing Benjamin Graham's all-important margin of safety nearly impossible. With a stock completely disconnected from traditional market stability and severely lacking in consistent earnings, trying to calculate a safe entry point becomes the ultimate headache for any serious financial analyst.
So to try and cut through all that noise and hype, we have to go back to Peter Lynch's philosophy. He famously advocated looking past high-tech buzzwords to focus entirely on actual, unbroken earnings growth. Lynch's famous fair value formula is beautifully simple but brutally honest. You just take the company's earnings growth rate and multiply it by their trailing 12 months earnings per share. He also relies heavily on the PEG ratio, which is price to earnings divided by the growth rate. But Trying to assess this exposes a massive, critical structural flaw when you apply these legendary frameworks to a pre-profit tech company. Here's the fatal flaw for SoundHound. Because they have a trailing 12-month earnings per share of negative 32 cents, the Peter Lynch fair value calculation literally breaks down completely. It spits out a theoretical fair value of negative $1.60 per share. You physically cannot calculate a favorable PEG ratio without a positive E for earnings. And it's not just Lynch's models failing us here. Benjamin Graham's famous intrinsic value formula, the square root of 22.5 times EPS times book value per share, it completely shatters in the exact same way. You can't take the square root of a negative number. Through the strict lens of these value investing titans, the math physically does not work.
Okay, since the traditional earnings formulas literally break upon impact, rigorous analysis forces us to bring out the heavy artillery, a discounted cash flow, or DCF model. To build a base case DCF, we have to forecast all the free cash flow this company is going to generate over the next 5 to 10 years, apply a perpetual terminal growth rate, and then discount all that future cash back to its present value using the company's weighted average cost of capital, or WACC. By projecting future cash flows instead of relying on today's massive negative earnings, we can finally attempt to isolate the true intrinsic value of a single share.
Brace yourselves for this one. According to valueinvesting.io's rigorous DCF model, SoundHound's intrinsic value comes out to a mere 2 cents per share. Yeah, 2 cents. This suggests that at its current market price, the stock is overvalued by a staggering 99.7%. And as expert analysts, we have to point out that even if we run a sensitivity table, even if we tweak the WACC or the terminal growth rate to be as optimistic as humanly possible, that heavy near-term cash burn acts like a massive anchor on the present value. You are paying a colossal premium today almost entirely based on the hope that they drastically outperform the projected financial trajectory.
And it gets riskier. If we dive into the SEC filings, they paint a pretty vivid picture of the hidden dangers contributing to this rock-bottom valuation. They list rapid-fire risks ranging from intense competition from other AI vendors to a heavy reliance on third-party service providers. Let's connect this back to our investing gurus. That intense competition directly threatens Graham's strict requirement for long-term earnings stability. Meanwhile, their heavy reliance on third-party telecom infrastructure totally undermines Buffett's concept of a truly impenetrable, self-sufficient economic moat. Basically, the company's fate is partially tied to systems they don't even control.
On top of that, the company itself explicitly warns investors, right there in black and white, that their substantial net losses and negative operating cash flows are expected to continue for the foreseeable future. That is a massive red flag. Delivering this as a clear warning, this directly fails Warren Buffett's criteria for manageable debt and strong financial condition. As SoundHound keeps pouring money into development and absorbing the heavy costs of massive acquisitions, these compounding expenses create an incredibly high risk of future shareholder dilution just to keep the lights on.
So, bringing it all together, evaluating SoundHound means we have to weigh the incredibly impressive technological narrative of their AI moat against the cold, brutal realities of their financial math. Synthesizing our frameworks paints a really stark picture. Our DCF model values the company at mere pennies on the dollar. Peter Lynch's framework values it at negative $1.6, and Benjamin Graham's intrinsic value formula mathematically self-destructs. The incredible top-line momentum we saw at the start is just fundamentally at war with extreme cash burn, zero current profitability, and valuation models that suggest this stock is running purely on fumes.
Let's wrap up this synthesis. Based on the hard data and the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, SoundHound AI is currently a definitive sell or avoid for value investors. These financial titans wouldn't touch the stock with a 10-foot pole until EPS turns positive and the price drops significantly closer to its DCF intrinsic value to provide a genuine margin of safety. So as you look at your own portfolio, you really have to ask yourself, are you willing to ignore the greatest financial minds in history and stomach massive quarterly losses, all for the chance to own a piece of the conversational AI future? Thank you so much for joining me for this explainer, and remember, always keep looking past the noise.